There's a date circled on the calendars of every serious macro trader right now. Not because it's a holiday, not because of some earnings report, but because June 16th is the moment the entire interest rate narrative, the one that's been suppressing silver for the better part of 2 years, gets tested against a completely new force. Kevin Warsh is about to chair his first federal open market committee meeting, and if you own silver, or you've been thinking about owning silver, what happens in that room matters more than almost anything else you've read about this market in the last decade. Let's slow down and actually think about this. Most people who follow silver track the spot price. They watch the chart. They see the number go up, they feel good. They see it pull back, they get nervous. But the traders who consistently make asymmetric returns in this metal, they're not watching the price. They're watching the architecture beneath the price, the institutional framework, the policy scaffolding, the invisible hand that determines whether the real return on holding dollars feels like a reward or a punishment. Because when that invisible hand changes, when the person gripping it changes, everything downstream moves. And Kevin Warsh is a very different hand than Jerome Powell. To understand why June 16th is significant, you have to understand what's actually been holding silver down. Not the narrative you hear in retail circles about manipulation or suppression, though those conversations exist. The real mechanical force suppressing silver's purchasing power appeal has been the sustained elevation of real interest rates. When the Federal Reserve holds nominal rates high and inflation begins to moderate, the real yield, what you actually earn after inflation, becomes positive. And when real yields are positive, the opportunity cost of holding silver, which pays no interest, no dividend, no coupon, that cost becomes very real. Institutional allocators rotate away from metals and toward yield-bearing instruments. It's not emotional, it's mathematical. This is the environment silver has been navigating, but that environment is about to encounter a new pilot. Kevin Warsh isn't a career central banker in the traditional sense. He served on the Federal Reserve Board of Governors from 2006 to 2011, which means he was in that building during the greatest financial collapse since the Great Depression. He watched the system nearly come apart. He watched Ben Bernanke make decisions that were unprecedented in the institution's 100-year history, and critically, he disagreed with many of them. Not privately, publicly. He was a dissenter on the pace and scale of quantitative easing. He wrote op-eds. He gave speeches. He pushed back against the idea that the Fed could simply manufacture economic stability through the sustained expansion of its balance sheet without long-term consequence. That's a philosophical fingerprint that doesn't wash off. And now that fingerprint is about to be pressed onto the most powerful monetary institution in the world, at a moment when the policy questions are arguably as consequential as any since 2008. Think about what Warsh is inheriting. He's inheriting a Federal Reserve that has held rates at levels not seen since before the global financial crisis. He's inheriting a balance sheet that, while reduced from its pandemic peak, remains historically enormous. He's inheriting a labor market that has shown resilience but is beginning to show cracks. He's inheriting a trade environment that has been dramatically reshuffled by tariff policy. He's inheriting an inflation picture that is neither clean nor catastrophic. It's muddy, uncertain, and politically charged. And he's inheriting a market that has priced in a very specific story about what the Fed will do next. That story is about to be interrogated. Here's where silver's structural case begins to sharpen. There are two directions Warsh can credibly go, and both of them, for very different reasons, are constructive for silver. That's not a coincidence. That's a reflection of silver's unique dual nature as both a monetary metal and an industrial commodity, a characteristic that makes it responsive to a wider range of macro outcomes than almost any other asset. The first direction is hawkishness. Warsh could arrive at the FOMC with a signal that he intends to maintain elevated rates longer, that he's watching inflation expectations more carefully than the market currently assumes, that he believes the Fed's credibility must be defended against political pressure, because in recent months there has been no shortage of political pressure on the central bank to cut. If Warsh signals this kind of resolute independence, if he separates himself from the rate cut narrative that markets have repeatedly tried to price in and been disappointed by, something interesting happens. The dollar initially strengthens, real yields hold firm, and then the market begins to process the implications for the broader economy. Slowing credit creation, compression of housing activity, corporate refinancing stress. A consumer who has been running on credit card debt at record interest rates beginning to retrench. Growth slows. And in a slowing growth environment, the conversation shifts from inflation to stagflation, the dreaded hybrid. And there is no better performing hard asset in a stagflationary regime than silver and gold. Look at the 1970s. Look at the data. It's not theoretical. The second direction is dovish signaling. Warsh could arrive. And this is the scenario fewer people are gaming, having recalibrated his views based on the data in front of him, rather than the philosophical priors from his 2010 op-eds. He could look at tariff-driven cost pressures, at softening labor data, at global growth deceleration, and determine that the restrictive stance has served its purpose, and the balance of risks has shifted. If he signals a credible pivot, even a partial one, real yields decline. The dollar softens, and silver, priced in dollars, gets a direct mechanical boost. Not just from currency effect, but from the flood of institutional capital that has been sitting on the sidelines, waiting for exactly this signal before rotating back into precious metals. Two very different outcomes, same directional pressure on silver. But the deeper story here isn't just about interest rates. It's about what Warsh's appointment signals about the institutional relationship between the Federal Reserve and the Treasury. Because Warsh has deep, long-standing ties to Republican economic circles, his appointment didn't happen in a vacuum. It happened against a backdrop of an administration that has been vocal, loudly, publicly vocal, about wanting lower borrowing costs. And a new Fed chair, regardless of their intellectual independence, must navigate the political reality of their moment. Not by surrendering to it, but by being aware of it. Every signal Warsh sends on June 16th will be filtered through the lens of, is this man independent, or is he accommodating? And that question, that uncertainty itself, has historically been a tailwind for monetary metals. Markets price certainty at a premium. When certainty is removed, when the institutional framework that governs the price of money itself becomes uncertain, capital seeks anchors. Physical assets, real stores of value, things that exist outside the promise chain of the financial system. Silver is one of those anchors. Now let's talk about the industrial dimension, because this is where silver's story diverges entirely from gold's and becomes something more interesting, more textured, and in many ways more urgent. Silver isn't just a monetary metal. Roughly half of annual silver demand, and in some years more than half, comes from industrial applications: electronics, soldering, brazing, medical devices. And then there's the category that has changed silver's demand profile more dramatically than anything in its history: the green energy transition, solar panels. Every solar panel manufactured today contains silver. The photovoltaic cells that convert sunlight into electricity use silver paste as a conductor. And the scale of solar deployment globally has been extraordinary. China alone has been installing solar capacity at a pace that regularly breaks its own records. The United States, Europe, and emerging markets are following. The International Energy Agency has published projections for solar capacity growth that, when you translate them into silver demand, produce numbers that the silver market, a relatively small physical market compared to gold, struggles to absorb without price response. And then there's the electric vehicle ecosystem. EVs use significantly more silver than internal combustion engine vehicles, both in the vehicle's electronic architecture and in the charging infrastructure. Every charging station, every battery management system, every autonomous driving sensor suite. Silver. This is the physical demand reality underneath the price, and it exists independently of whatever Kevin Warsh decides on June 16th. It exists independently of Federal Reserve policy. It's a structural, multi-decade shift in how human civilization generates and manages energy, and silver sits directly in its path. The combination of monetary sensitivity and industrial demand inelasticity is what makes silver's risk-reward profile unusual right now. You have a monetary asset that benefits from uncertainty and monetary debasement concerns, layered on top of an industrial commodity with genuine structural demand growth. Those two forces don't always align. When they do, historically, the moves have been significant. Let's talk about the gold-silver ratio, because this is a number that every serious silver investor should have memorized and should be monitoring with the same discipline they apply to spot price. The gold-silver ratio tells you how many ounces of silver it takes to buy 1 ounce of gold. For most of recorded monetary history, going back centuries, this ratio hovered between 15 and 20 to 1. That's not arbitrary. It roughly reflected the natural geological ratio of silver to gold in the Earth's crust. In the modern era, the ratio has been structurally higher, often trading in the 60 to 80 range. But during stress events, during monetary crises, during periods of institutional distrust and safe haven demand, the ratio compresses. Silver outperforms gold dramatically. In recent times, the ratio has been elevated. That elevation represents either a permanent structural shift in how markets value silver relative to gold, which is possible but requires justification, or it represents a coiling spring, a relative value opportunity that institutional capital hasn't fully exploited yet. The argument for the spring is compelling. Silver is cheaper relative to gold than its industrial demand profile would suggest it should be. The solar transition alone should be repricing the ratio. That it hasn't fully done so yet suggests either that the market doesn't yet believe the energy transition will materialize at projected scale, or that monetary headwinds, elevated real rates, have been strong enough to suppress even the industrial premium. Remove the monetary headwind. Watch what happens to the ratio. This is the trade that some of the most sophisticated commodity desks in the world are quietly positioning for. Not with fanfare, not with retail newsletters, with patient accumulation, spread trades, and option structures that profit from ratio compression. Now, it would be intellectually dishonest not to address the risks, because silver can hurt you. It can hurt you badly and quickly if you're not positioned with clarity about your time horizon and your thesis. Silver is volatile, more volatile than gold, more volatile than most people expect until the first time they watch their position move 10% in a single session. If the FOMC on June 16th surprises with unexpectedly hawkish language, if Warsh signals that he sees inflation risks as more persistent than the consensus assumes, and that he's prepared to hold rates higher for longer than markets have priced, the immediate reaction in silver could be sharp and painful. Real yields spike, the dollar catches a bid, silver sells off. If you own silver on a leveraged basis, that kind of move can be devastating. If you own physical silver with a multi-year time horizon, it's a temporary paper loss on an asset that hasn't changed its fundamental properties at all. The metal in your hands is still the metal in your hands. The solar panels still need the silver. The monetary uncertainty hasn't resolved. You've just been given a lower entry price to add to your position. But that distinction between leverage and duration is not one that should be glossed over. Position sizing matters. Knowing your time horizon matters. Understanding whether you're trading the FOMC reaction or investing in the multi-year monetary and industrial thesis matters enormously. There's also the geopolitical dimension that's been reshaping commodity markets in ways that are only beginning to be fully priced. The fracturing of the global trading system, the imposition of sweeping tariffs, the counter-responses, the renegotiation of supply chains that took decades to build, this isn't just a trade war story, it's a monetary story. When global trade flows are disrupted, when the dollar's role as the uncontested settlement currency for global commerce is at least questioned, if not yet substantially diminished, the demand for alternative stores of value increases. Not instantly, not in a straight line, but directionally and persistently. Central banks globally have been buying gold at a pace not seen in decades. That's not retail sentiment. That's sovereign balance sheet management. Institutions that have studied monetary history more carefully than anyone, deciding that a larger allocation to monetary metals is prudent in a world where the geopolitical landscape is less stable than it was 5 or 10 years ago. Silver follows that story with a lag and an amplification. It follows gold's monetary premium and then adds its own industrial scarcity premium on top. Consider also what's happening in the mining supply picture. Silver supply is inelastic in the short term. Most silver isn't mined primarily as silver. It comes as a byproduct of base metal mining, copper, zinc, lead. When those industries slow in response to global growth concerns, silver byproduct supply declines. New primary silver mines take years, sometimes over a decade, from discovery to production. The supply response to higher prices is slow, which means that demand increases hit a relatively fixed supply base. Price has to do the work of clearing the market. This is basic commodity economics, but it's easy to lose sight of when you're watching the daily price chart. Let's return to June 16th and think carefully about what you should actually be watching when that FOMC statement drops. The statement itself matters, but the press conference matters more. This will be Warsh's first opportunity to communicate directly to the global financial community about his framework for thinking about monetary policy. Listen for how he characterizes the inflation risk versus the growth risk. Listen for whether he emphasizes the Fed's independence or whether his language is more accommodative toward the current political environment. Listen for how he discusses the balance sheet, because Warsh has historically been skeptical of the idea that an enormous central bank balance sheet is costless or benign. Any signal about the pace or direction of quantitative tightening will reverberate through real yields, and by extension, precious metals. Listen for how he talks about uncertainty. Chairmen who acknowledge structural uncertainty in their outlook, who don't project false confidence about where the economy is headed, tend to send capital toward hard assets as a hedge. It's not a guarantee. but it's a pattern. And listen for what he doesn't say. The omissions in a Fed chairman's press conference are sometimes as informative as the statements. If he doesn't provide clear forward guidance, if he pulls back from the kind of explicit future-oriented communication that Powell used extensively, that uncertainty itself becomes a macro variable. Beyond June 16th, think about the sequence of data releases between now and then. The inflation prints, the employment reports, the consumer sentiment numbers. Each one is a piece of the puzzle that Warsh will be assembling in real time, and each one shifts the probability distribution of what he decides. Silver will react to each one. The volatility in the weeks leading up to the meeting creates both risk and opportunity, depending on how you're positioned. There's something else worth sitting with, and it's less analytical and more structural. We are in an era of what might be called monetary regime questioning. Not monetary regime change, that's too strong, and it would be intellectually irresponsible to present it as inevitable, but questioning. The dollar's dominance isn't collapsing, but it's being stress-tested in ways it hasn't been in 50 years. The Bretton Woods consensus that structured global monetary relations for decades has been gone since 1971. What replaced it? Dollar hegemony, petrodollar recycling, treasury market depth as the global safe haven. That system has shown remarkable durability. But durability isn't immortality. When systems that have been stable for a long time begin to show even small fractures, the historical pattern is that monetary metals attract attention well before any actual regime change materializes. They're the canary. They're the hedge. They're the instrument that says, I don't know exactly what comes next, and I'm not certain anyone does, so I want exposure to something real, something physical, something that has maintained purchasing power across monetary systems that came and went, while silver and gold endured. Kevin Warsh is one man, one meeting, one date, but he is also the representative of a pivotal institutional moment. A new leadership philosophy at the world's most important central bank, arriving at a moment of genuine macro uncertainty, genuine monetary regime questioning, and genuine structural demand transformation in the silver market, all simultaneously. That convergence is not something that happens often, and when it does, the investors who have thought through the thesis carefully, who have positioned appropriately relative to their risk tolerance, and who have the patience to let the thesis develop rather than trading the daily noise. Those investors tend to look back on the entry point as having been more significant than it appeared at the time. That's not a prediction. Markets are probabilistic, not deterministic. Silver could underperform for reasons that are legitimate and data-driven and have nothing to do with flawed analysis. But the asymmetry of the argument, the idea that the downside is bounded by genuine industrial utility and historical monetary function, while the upside is driven by a potential cascade of monetary, geopolitical, and energy transition tailwinds, that asymmetry is what makes this conversation worth having. What you do with it is yours to determine. Your time horizon, your position size, your conviction level, your understanding of the risk. These are personal variables that no YouTube script should be making for you. But having the framework clearly in mind, knowing what you're watching for, knowing what the signals mean, knowing why June 16th sits at the intersection of multiple converging narratives, that clarity is the difference between reacting to price and understanding it. The silver market has a way of being boring for a long time and then doing something remarkable in a compressed period. It spent years below $30. It moved through 30. It tested levels that had been ceilings for years. And each time institutional interest builds, each time the monetary backdrop shifts, each time the industrial demand data comes in stronger than the consensus expected, the case for another leg higher gets incrementally stronger. Not because of hope, because of the mechanics, real rates, industrial demand, supply constraints, monetary uncertainty, geopolitical realignment, Fed leadership transition, gold-silver ratio compression, energy transition acceleration. These aren't feelings, these are variables, and right now more of them point in the same direction than at almost any other point in recent memory. June 16th is one date, but it's a date that could crystallize several of these variables at once, either by confirming the monetary headwinds are easing or by creating the kind of policy uncertainty that sends capital scrambling toward exactly the kind of anchor that silver represents. Watch it carefully, think about it clearly, and whatever position you hold it with understanding, not just hope. Because in this market, in this moment, the people who understand what they own are the ones who don't panic when the chart moves against them, and don't chase when it moves in their favor. The metal doesn't change. The narrative around it does. Your job is to see through the narrative to the structure underneath, and right now, the structure is speaking.